What's up, guys? I'm Jeff Montgomery and welcome to Tax Planning on the Whiteboard. Should you do a QCD on an IRA? A better question may be, what in the world is a QCD and are you eligible? In this episode, we're going to give you the definition of a QCD and the top 5 rules you must know. Just a reminder, if you like what you hear and you want more whiteboard videos, just click that subscribe button. And also, disclaimer, we are talking about tax planning. This is not specific information to anyone watching the video. I want you to use this as general information and education only. Please don't implement any strategies you see or hear on this video without talking to your tax professional first. So let's begin. What does a QCD stand for? Well, it stands for a Qualified Charitable Distribution. And it's a way for you to move funds out of your IRA to a qualifying charity, income tax free. You might say, but wait, Jeff, if I want to donate to a charity, why not just write them a check? Well, you could, and that would be perfectly fine. And we all know you only donate to a charity because you want to help. I understand that. And who cares about the tax benefits? Well, I agree, but to a certain point. After all, it's called tax planning on the whiteboard. So if you wanted to also get a tax break by donating to a charity, you have to itemize. Typically, most people are not getting that tax break today because they are claiming the standard deduction on their federal income tax returns. As a matter of fact, nearly 9 out of 10 claim the standard deduction. In 2022, the standard deduction for married filing jointly is $25,900 plus $1,400 each if you're 65 or older. And for single filers, it's $12,950 plus $1,750 each if you're 65 or older. So a QCD could be a good solution to contribute to a charity directly from the IRA. You never touch the money. The beauty of this strategy is that the amount of the QCD is not taxable, and you don't have to itemize to get that tax breaks. But there are 5 rules to follow, and these are the top 5 rules to make sure that you do them accurately and you do them correctly and within current tax law. So let's go to the whiteboard to talk about those 5 top rules. Okay, guys, the top 5 rules, we're going to write these out on the whiteboard when doing a QCD on an IRA. Number 1, we have to make sure that you are over 70 and a half years of age. 70 and a half years of age. Now, doesn't that sound familiar, 70 and a half? That was the old pre-Secure Act required minimum distribution start date. After the Secure Act of 2020, they changed that to age 72. And what's interesting about required minimum distributions, it is the year you turn 72, you have to have out your first RMD. However, you can wait a grace period April 1st of the year following the year you turn 72. But this is really interesting with this QCD rule. You have to be over 70 and a half, and they take that literally. You can't be, it's not the year you turn 70 and a half. So you have to be 70 and a half or older, okay? So make sure it is after you turn 70 and a half. Very, very important. After you turn 70 and a half, you are allowed to do a QCD. Now, number 2, let's talk about the eligible funds. What type of accounts can you do a QCD? So eligible funds would be accounts, or let's call them accounts, eligible account types, would be your traditional IRA, okay? Everybody is very familiar typically with a traditional IRA. RMDs begin at 72. You can do QCDs as early as 70 and a half. We just talked about that. So traditional IRAs. You can also do those with Roth IRAs. I'm not sure why you would want to do a Roth IRA because a Roth IRA is tax-free, but I guess you could do it. It's possible. You can also do a SEP or a simple IRA. SEP or simple IRA. However, you have to make sure those are not ongoing SEPs and simple, meaning that you're done contributing to them. You've just left them in that account title. Now, most people are going to probably roll over SEP or simple IRAs into a traditional IRA, but if there's still some hanging out there, I've seen that situation, you can still do a QCD on a SEP or simple IRA as long as you're not funding them. They're not ongoing. So that's rule number 2. Rule number 3, we have a $100,000 annual limit. All right. Now, if you're married filing jointly, that is $100,000 each, okay, for each spouse if married filing jointly. So you could give away $200,000 directly through a QCD from the custodian directly to the qualified charity of your choice, up to $100,000 annual limit. Pretty self-explanatory. Explanatory. The important point here, there are no carryovers. So if you do $100,000 and or more than $100,000 and you wanted to carry that difference over to the next year, you are not allowed to do that. There are no carryovers to the following tax year. Very important. Number 4, I think, kind of one of the main reasons to do this, it satisfies your RMD. So at age 72, your RMDs begin, and you can do a QCD to satisfy any or all of your RMD. You do not have to do the whole thing. Example, let's say your RMD is $10,000. You take that out of the one way to give to charity is you take it out of your IRA account, you pay the taxes, you deposit it into your checking account, and then you write a check to the charity. But guess what? But in order to get the full deduction of that $10,000, you have to itemize. And again, most people are not itemizing because the standard deductions are so high. So again, if you do the QCD for your RMD after age 72 and have the custodian send it directly to the charity or charities of your choice, you can do any and all. You could do the whole $10,000, you could do $5,000, keep $5,000, whatever you want to do. It's very flexible. You will have paperwork documenting what qualified charity you sent that to. So again, it can satisfy your RMD. And what's really interesting with that is you are still going to get a 1099, okay? And this is why this is such a tax efficient strategy. You're going to get a 1099 saying it was a normal distribution out of your IRA. It's actually going to look like it's taxable, and you have to report that as a taxable distribution. After all, the custodian is sending the 1099-R to the IRS as well. But what you have to do, your responsibility is to communicate with your tax preparer. If you're preparing your own taxes, you have to document how much of that went to a qualified charity, and you're also going to have the documentation already because the custodian is going to require documentation to send that to the qualified charity. So you'll have that as proof. But just keep in mind, you are still going to receive a 1099-R, okay? Your responsibility to report it and document how much of that 1099-R is a QCD. I like to say that a QCD, the 1099 is blind to the QCD. It does not know that you actually did a QCD. The custodian is just sending it out and saying, hey, this is a normal distribution. All right, and then number 5, we mentioned this numerous times. It requires a direct transfer from the custodian to the qualified beneficiary. Again, if you took it yourself and wrote the check, then if you're not itemizing, you're not getting any benefit. If it goes directly to the custodian, it is not going to be a taxable distribution to you, and it will satisfy your required minimum distribution at that age of 72 and beyond. But again, keep in mind, you can do these as early as age 70 and a half. So interesting tax planning strategy here. Keep them in mind. If you are charitably inclined, make sure you follow the rules. Make sure you do those QCDs correctly. This is Jeff Montgomery for Tax Planning on the Whiteboard. I hope you learned something today. If you like our videos, hit subscribe, and we'll see you next time.